We've already seen some of the impact, at least some of the impact in financial markets of all the massive fiscal spending and all the massive monetary stimulus, stock prices at record levels, negative real yields on treasuries, negative nominal yields on sovereign debt around the world. Where does it go from here, Ray?
Well, first, I want to convey the mechanics of that. When there's more, you run a larger deficit, and there's printing and buying of financial assets, it drives down real yields, and as a result of this, it drives money into alternative assets. There's a supply-demand problem for bonds, but when the central banks at the end of the day print, in much the same as Roosevelt did in March of 1933, that causes financial asset prices to rise and supports the economy, but diminishes the value of debt, the real value of debt. So that's the dynamic. Where we can expect it to go from here is always that way in a greater degree. So we know that if a big bill is passed, or if next year we have a larger deficit, we know that the Federal Reserve will be faced with the choice of either allowing interest rates to rise or buying that and monetizing that debt. And that diminishes the value of those bonds because it's just supply demand. When you have that debt, you have to sell it. And when we look at who are the buyers of that debt and how much do they have of it, we're dealing with a situation like in the 30s that could be threatening even to the reserve currency status. In any way, it diminishes the value of that which is being produced. That means money and credit, and it drives money into those other assets. So it's that kind of market action.
Is there a real threat right now to the U.S. dollar's status as the world's reserve currency?
Yes, there is a threat. It's an evolutionary type of process. There's not yet a good alternative in the form of a currency per se, but people are not investors, big, large institutional investors don't run out necessarily to alternative currency because the three major reserve currencies all have the same basic problem. That's why they move into a new storehold of wealth. And you see that the storehold of wealth, like in 1933 reaction, is equities, is gold, is other asset classes that go up. So when you buy a company and you have low returns on your bonds and so on, that is that kind of movement, but the same is true for gold and other asset classes. If that gets too far, and it's standing the risk of, it's very dangerous. It looks like a currency defense. In other words, if those who are holding bonds, which are a lot, choose to sell the bonds because they're not providing a good return, and they're not, and because there's so much debt production and debt monetization, that puts the Federal Reserve or other central banks in the very difficult position of operating like a currency defense. Mechanistically, as money leaves that debt, that means either interest rates would rise, which would be terrible for the economy and markets, or they're forced to buy more and more. And that is how a spiral could occur. Well, I think we have to realize we're in a period of great risk. And the most important thing is to know how to diversify well, to diversify by asset class to achieve balance, to diversify by country, and to diversify by currency. Diversification well is the most important thing to achieve that balance.
So if I'm understanding you correctly, if an investor were to have the plurality of his or her assets in the United States, U.S. domiciled assets, U.S. dollar denominated assets, now sounds like a good time to think about diversifying into other currencies and other domiciles?
That's right. And also, for example, does gold is it part of your portfolio? Are inflation index bonds part of your portfolio? Mm-hmm. You know how to balance those asset classes. I think there's a bias that's a dangerous bias. And that bias is that the recent past that we've experienced is representative of the future. And if you go through history, when you have some of these conflicts, you might have a different result. And diversification doesn't cost you anything, because when your asset classes are going to, if you balance them right, have approximately equal expected risk adjusted returns. So you can balance them because they all compete with each other. So not one is necessarily clearly better. So diversification is a wonderful, mechanical, good way to reduce risk without reducing expected return.